Listen-only mode.
Good day, everyone. Well, the markets continue higher on the ongoing favorable news regarding Trump's tax policies. The majors closed at new highs yesterday, with the exception of, well, the small cap Russell, but that looks like it's on the verge now as well of breaking out of this sideways consolidation. I mean, it did have a big move higher post the election, so it looks okay, and small caps are still doing pretty well. They've been outperforming all the other asset classes, well, stock market capitalizations since the election. Essentially, we're in an uptrend by and large, and so far so good. We've had a couple names from the focus list do both. One well, in the case of NVIDIA, it had a mini gap higher, but now it's reversed that. And of course, after earnings, you got to be mindful that there's going to be turbulence in the way a stock trades. There's often tug of wars in terms of whether they should be higher or lower. And
hey, Dr.
NVIDIA looks like in the middle of that right now. Yeah.
I'm noticing on the 620 chart in NVIDIA is starting to show a turn here. I wonder if this thing's going to come back. The earnings were actually pretty good, so if you look at the daily chart, you can see it's holding the 10-day line. I don't know if you guys can see that, but it's holding above the 10-day line. It held the 20-day line on the pullback, so you know it could be setting up in a little cup with handles. So I don't know if I'd write it off just yet. I want to see if it settles down, but right now, if you wanted to use a 620 chart on this, you could take a stab here and use like 115 as maybe, well, right now you're looking at a cross below would be about 114.90, 92, somewhere in there. And then you could bail out if it didn't work. But this is a possibility right here to actually come in on the stock, believe it or not. And so far, I would say on the daily chart, it's holding up. So I know Yelp wasn't so lucky, right?
Yeah, a couple of these. Obviously, if they're gapping lower, you got to just sell them at the open. But you know, Yelp had earnings reporting today, so you know that's earnings roulette, especially in this kind of market. You really can't rely on the price volume action leading up to the earnings to dictate whether you should be buying the day before earnings.
Funny,
It's
a
not
good
like
story from yesterday, Dr. K. Remember yesterday we were talking about this, and I said, I'm going to buy 1,000 shares here and hold them into earnings. And I watch it trade for like the next hour or so, and finally I just said, I'm not even going to bother, and I'm glad I didn't. But my general view is basically never to play earnings roulette unless you have a nice profit cushion. And I don't think that it was ever possible to get too much of a profit cushion on this one. I think the pocket pivots were down along here in the 40, 41 area. So, you know, in that case, you'd have been knocked out right away. But I don't think there was enough cushion, even if you bought at the 10-day line, to want to play this through earnings. So, you know, and you're just rolling the dice anyways.
Yeah, I mean, back in the day, this would be before all the market manipulations came in, you could use the day or two before earnings as a clue. The odds were on your side, especially if there's a lot of volume coming into the stock the day before earnings, and or in the case of a stock reporting after earnings, the way it traded that day. You know, it was good 80–90% in your favor at least, but in the last few years you just can't do that. Can't do that anymore. So yeah, you got to really make sure your position size is geared up so that in the unlikely event it has a major gap down, say 30% or more, you'll be okay. You know, so you have to kind of ask yourself that question in any of the stocks that you're holding before they go into these earnings reports. We've got a bunch of names on the list that we've been commenting on. I mean, we can just go right into that. There's not a whole lot to say about the markets right now. I mean, things are pretty quiet and they're in uptrends. Leading stocks are looking, you know, relatively okay. I mean, the NASDAQ 100 is in a nice sharp uptrend there. even though some of the FANG stocks like Amazon that had a gap lower after earnings and now it's trying to creep higher, it doesn't look all that great, but it is a leading stock. So if things continue higher, Amazon should continue as well.
Hey, Dr. K, there's something here. There's a subtlety here that I think some of you might want to notice. Number one is that we put this thing on down here when it came up to the 50-day line back in early January. And it ran up to new highs, I believe. Those are new highs, right, Dr. K? Is it? I got to check this.
That not quite.
Well, no, it got
Just
up to the, yeah, almost back up to the top of the base. Okay, but think about this a little bit. And I think we wrote about this over the weekend, and that is that, okay, the stock ran up here, and it really put in a one-week handle, so it's not really enough time to generate a big move. So what happens after earnings, there's a reason to sell because the revenues from Christmas sales weren't what they thought or whatever. But I see Amazon, I mean, let's face it, they're a retail e-commerce juggernaut, and I see them more as a cloud play as well, because that's where a lot of their revenue and earnings are coming from. And they're supposed to make something like, what, $35 in a couple of years a share. So it isn't expensive. And so what happens here, and if you're paying attention, you notice this low right here, is what right here, this low right here is, what's the price on that one? Let's see, I gotta get back to here. Let's see. The low there is 803.44. So on Monday morning it hits 803. So the stock undercuts that low by 44 cents. What does that do? It sets up an undercut and rally. If you were awake to that, actually, you could have bought the stock because it was sort of skidding to a stop here, because the volume, as we pointed out over the weekend, the volume is diminishing, or actually earlier in the week in a pre-market pulse piece, we pointed out that you have this big selling here, and then the next day it kind of stops, and see how it gets support, and that's the day that it undercuts. So that's giving you a clue that this may turn, and it does. So it fills a gap now. And the question is whether this is going to hang in tight. And I would actually watch for this thing to hang in tight, because I would not be surprised if this market continues higher that Amazon doesn't go higher too. But there was a subtle entry point, and that's also very similar to what we saw in NVIDIA, which is still on our list. And we're just talking about this. I hope you don't mind me taking the forefront here, Dr. K. I know you're tired because you're moving. You're in the process of moving and dealing with stuff. So
go right in.
Okay.
Like I said, there's not a whole lot to be said about the general market. I think talking about the stocks is more interesting.
Yeah. Okay. So I'll go ahead and take it, and I'll bring you in where I need you. But anyways, you can see NVIDIA here did the same exact sort of thing. It broke down after earnings. Everybody said this climax top, and it looks sort of climaxy. But I know in this market how these things work. So it undercuts this low. And you can see that when that happens, volume isn't all that heavy, so you kind of been diminishing all this heavy selling volume that you saw, and then it turns back to the upside. Now you get a classic double top type formation, but as Bill O'Neill used to say to me, every cup and handle is a double top, and when it starts forming the handle, a lot of people think it's a double top and they want to short it, and you could have actually gotten away with scalping this on the short side this morning, and it makes sense here that this didn't, like Amazon, it needs to put in some time in here. So I think, what does it look like on the weekly chart? Let me pull this thing up.
I mean, NVIDIA.
Yeah, I mean, it's
I think the thing is, had that reversal on the weekly chart on high volume, which what was a intermediate, well, a short-term top anyway, right. And the stock rightfully came back down, and in fact came back down to its 50-day, or rather 10-week moving average eventually, and it's gotten traction there. But I wouldn't be surprised to see this base requiring a little bit more time, where the stock can really resume that uptrend that it had in 2016.
Yeah, I wouldn't be surprised to see it spend a few days hanging along the 10-day line and then take off again. That seems the way things go in this market. Things look ugly at one point, and then they just turn around and hit higher. And a really good example of that is U.S. Steel is hopping and bopping here. You pick up a pocket pivot yesterday off the 50-day line. But again, notice how you get this situation and I would suggest watching for these, where you undercut all these lows and you got this big volume selling here. But the very next day you turn right back above and you post a pocket pivot coming right back, and then it hangs tight along the 10-day line. It's just under the 50-day line, but it hangs tight in here, and then boom, we take off again. Comes up to the highs of the base. So I'll trade it from here to here, sell it, and then watch and see if it pulls in, and then maybe heads out again. With my luck, it'll just keep going higher today. But a lot of times you see these breakouts occur, and they don't hold up in the short term, so they give you a chance to come back into them. So, for example, look at Momo. This guy's got some Momo going on here. But if we look at the pattern here, it's kind of a slightly V-shaped cup on the weekly pattern. So it's a bit of a trend line breakout. But we put this on much earlier. But you get this trend line breakout here. Now you pull into the 10-day and the volume's light. So you don't want to buy the breakout. Just wait and see if it pulls in. You got that today. It dipped below the 24 level. So that actually was an entry point that you could have taken advantage this morning. But that's kind of how you have to handle these stocks. And you're not looking to. I'm almost never buying breakouts. In fact, I don't think I ever am. And instead, what I'm waiting is to see if the thing pulls back. I mean, even look back here when we put this on as a pocket pivot, which I think was here. It immediately fizzles out and then pulls in the 20-day. So you have to be opportunistic here and be buying it along the 10-day or the 20-day. And they're both kind of close to each other, so it's not, you could use that as a support zone, the area between the two moving averages. And you buy it on weakness, and that's really how you have to operate in this market. Now let's go to what's another one? Baba's another one, Dr. K. Here we go. This one again, it has a Bible gap up, but notice how it holds along the 100 price level, and that's where you have to be buying it. Then you run up. I was actually playing this off of that on Monday, and it turns up to the upside and gets to the top of the range. You sell into that. Now it backs up, and it's coming into the 10-day line. Probably becomes viable. I think longer term, this has a lot of potential. What do you think, Dr. K?
Yeah, well, the company is the Chinese Amazon. It's making all the right moves. Jack Ma is very capable, one of the most capable CEOs. So he's leading the show there. I got to say, AliExpress, which is the Alibaba's Amazon, is in some ways, well, I wouldn't say it's better, but it's different. And I use both Amazon and Alibaba to get most of my stuff these days. You don't have to shop. It makes going out to a store obsolete for the most part. I mean, whether you're doing clothes or groceries, electronics, and you're getting the best prices. So that's all to say that Baba, I think, has loads of potential going forward. Like Amazon, they are making the right moves. And right now, Alibaba's got a market cap of about $250 billion, and I think that could certainly increase. I don't know if Baba's going to go on a huge tear like Amazon did back in the early days, because like I said, it's a $250 billion company right now. I think it could get to easily $500 billion. It could be a doubler in a year's time, possibly. That'd probably be the outside, best case scenario. But overall, it looks constructive. So yeah, I'm actually a holder longer term in this one.
Yeah, and if you look at the weekly chart, you can see that back here it went public in 2015. It had a nice move, and then it broke down. You can go back and look at stocks like Baidu back in 2007, after it came public in 2005. You look at LinkedIn. These stocks, they came public, and then they kind of came apart, and they built these huge structures, and then they come out. And when they come out, they start to have a nice price move. A good example of that would be Weibo, which was running, so it came public and it went sideways for a long time, and then when it finally cleared out of that range, it had a nice big move, and now here it is breaking out again. And they come out with earnings, I think, in the next couple of weeks. I think this is moving along. You could throw it in with Baba and Momo. They're all kind of 6 of one, half a dozen of the other. And also NetEase is another one that's looking okay along the 10-day line, but that's where you have to buy it. They're kind of out their earnings soon. But in any case, my point here is that you've got Baba. It's got a cup with handle going on right now. You got a 2-week handle. So it might need a little more time, but it looks like it's setting up to move higher. If this market goes higher, I think it probably will go higher as well. And I agree with Dr. K. I think it has some long-range potential. But I'm not going to say that it could be fast or slow. I don't know. Because I've seen a lot of stocks that I thought would never be fast movers become fast movers in a hurry. So we'll see what happens with that one. Box is another one. I think they're coming out with earnings in early March, but that's just trended higher. It went kind of tight up here, and it's kind of extended. CUDA I like. I actually own this one. Nice shakeout on Wednesday to the 10-day line, so you got to buy on weakness. There it is. Boom. Moving back to the upside. Fortinet is the other stock in the cybersecurity group we have on the focus list, and it's hanging in a tight flag. Now, the one thing I notice here, and I'm not sure if this is necessarily a problem or not, but I'm not really interested in buying it up here. If it had, what I'd like to see is maybe the 10-day line comes in and it bumps into it. You see a lot of these Bible gap-ups go sideways for a period of time and then they launch, like Netflix. But you're noticing the volume's diminishing. It's kind of wedging along the low, so I don't know if it's going to have a quick yank back. And if it pulled into 37 or better, I think I definitely like this one, although it could also go higher. But it's acting pretty well. After the Bible gap up, you're using a 36.10, so $36 and a dime stop on that thing, but it looks okay, looks good. And I noticed CyberArk software today is getting hit on earnings after earnings last night, so it's coming down and getting tagged. And I think the key is you're going to see some winners and losers in the cybersecurity area, and where the winners have been these big, Checkpoint is one of them, and Symantec, these big old line cybersecurity names that have kind of feeble earnings, but they're going higher. But I got to think that some of these other smaller names will come along too, especially if they're acting well and they've already announced earnings. I think CUDA is definitely one of those. So FCX we've had on the list. Now, Dr. K has pointed out many times that commodity-related stocks will tend to have wider bands. They'll trade in wider bands, so you get a gap-up move today. It's actually trading down from the opening a bit, but it's holding the 20-day line, so this might be viable here using the 20-day exponential. Remember, always when I say 20-day line or whenever we refer to the 20-day line or moving average, we're talking about an exponential. You could use a 20 simple, or a 19 or a 22 or an 18 exponential, whatever. They're pretty much the same. So, and I don't consider moving averages to be hard lines as much as fuzzy zones, so you have to interpret them that way. Somebody's asking PI, UNR, just a quick. I don't see any UNR just yet. Well, it's kind of coming above this low, but I don't know. This stock's a little squirrely, and I think they come out with earnings when? When do they come out with earnings on this one, Dr. K?
Let me check the app. Okay, they're February 15th.
Yeah, so that's coming up, so I don't think I'd mess with it. Another one that's coming up with earnings soon is Nutanix, which is kind of interesting. If you look at this on a longer term, let's see. Well, since it came public, let's shrink this a little bit. You can see that it came public back here, and it had a big move, and then it died. So this is another one of these examples of a stock that has a big move after the IPO, and then it's setting up in a big base, and maybe something happens after they come out with earnings and the thing rocks. I don't know. But it looks like it's trying to set up. On the weekly chart, that's a little less clear. You don't have a lot of tight closes, and this looks kind of... Here, let's make this look less volatile. Ooh, look how tight that is. So no, let's make it even tighter. Well, I'm buying that. That looks so tight. What's in a scale here? There you go. Let me just scale it differently. I make it look tighter. Now that looks pretty good, right? And now it looks kind of loose. Now it's tightening up. So I think, though, the key is we just watch what's happening on the daily chart, and it's sort of setting up. I think you have a pocket pivot in here. Yeah, right here on would have been last Friday, so a week ago, and that's hanging in. So that's one to keep an eye on. Twilio is also interesting. Although they did have IPO expiration lockup expiration, so you got people selling shares. I actually played this yesterday, and it ran up 10% in a day off the 10-day line, so a lot of times that's something I'll take a profit on. And somebody's asking about how do you know when to take... obviously, this is a person who's relatively new, because you're asking a lot of questions that are typical rigid O'Neill types of pyramiding stuff. So number one, I don't ever watch, I don't ever hold stocks through earnings unless I have a profit cushion. If I get hit, I get hit, but at least I have a profit cushion. If I don't, I'm not going to mess with it. Sometimes I may just sell and take, half position off the table if I have a profit cushion, and hold on to the other half. Again, if I have a profit cushion. If I don't, then I'm probably not going to do that. So, but for the most part, anytime you own a stock and you buy it just before earnings, you have little to no profit cushion, and I would say less than 10%. I don't think you should be holding it, period. And you know, we can talk about, I know you're asking Matt here about can you give a quick overview of why you don't hold through earnings? Well, why do you think? Because there's too much risk. And if something gaps up, a lot of times it'll just become a buyable gap up. So if it's a stock I've been watching closely, I just buy into the buyable gap up. But you can see why there's just too much risk. And I'd never hold into anything ahead of earnings unless I have a profit cushion. So, you know, you don't know what it's going to do. So is the risk too great to take? In some cases, I think so. Go ahead, Dr. K.
We always joke that it's like playing earnings roulette these days, the last few years, because you can't really rely on price volume action leading up to that earnings report to guide you as to whether the earnings are going to be strong or weak. Back in the day, you could, but you know, markets have changed considerably, you know, since QE began in 2009, and then over the last few years, even more so. So yeah, it's better to keep, you know, risk control is your #1 rule when it comes to investing. So manage your risk, meaning don't go in with a position size into earnings that you'll regret if the stock gaps down a third or more on you.
Yeah, and so I'm also the person who's asking these questions saying, no, I had no cushion, I was only sitting on a couple of percent. Well, you made a fatal error in my view. So don't do that one again. So, you know, pay your tuition and learn the lesson, you know, and then you're also asking about, or is there a statistical basis? You know, throw all that crap out the window. There's a statistical basis. You have to use your judgment. You can't come to some conclusion about a stock based on some statistical study. I think that's all crap, frankly. You know, that 3 out of 4 of these patterns will do this. Well, no, there's certain setups that will act favorably or not, and you have to manage the risk on a real-time basis rather than just operating on the basis of some statistical probability. So I think that it's pretty, to me, it's pretty clear-cut what you do. Unless you have a big cushion, you don't hold through earnings. #2, if you do have a cushion of at least 10%, then you decide whether you want to keep a half position or not and hold through earnings. But the problem is made a lot easier if you can get a cushion ahead of earnings. If you can't, then just go away. You know, no need to play a hero in my view. So, you know, and you're taking too much risk. And in this market, and I think it's all since Regulation FD, which was Regulation Fair Disclosure, back in the day, as Dr. K will say, institutions used to get heads up from, you know, companies about their earnings and things, and you would see it on the chart patterns, and that would give you a clue that there was either something wrong ahead of earnings or something very right, and that's why pocket pivots ahead of earnings reports used to be very constructive. But now it's still just a crapshoot, and so it's changed a lot. I don't think, you know, again, the government wants to regulate things, but they screw things up more than they fix them, as we already know, and so I think that's all happened after Reg D was passed, or Regulation FD was passed. So anyways, I'm going to go through this because I think it's probably instructive. You write about the fact that you pyramid in your books. Well, we used to pyramid in the old days. I don't pyramid anymore. So the books are old, and we plan on, well, in our new mini conference that we're holding on March 18th, and there's only, what, like 15 spots left now, we're going to be covering a lot of that new stuff. Whether we ever write another book and update things, I don't know. But I don't pyramid anymore. You know, we don't keep adding stock. That's just a recipe for getting really top-heavy, and then when the thing blows up, you get your head handed to you. I employ more of a swing trading approach that campaigns stocks. Okay, so and then I'll be talking about that. We'll be talking about that at the mini conference. Anyways,
and books, by the way, they're really they're dinosaurs, just like a lot of these things that are going to go that direction. E-books are okay, but even more effective are articles that you know, stuff we do, you know, on a routine basis. You know, I've been putting out a lot of articles in different formats, and you know, that gets immediate traction, and you don't have to wait for the publisher, you know, to do all the printing and whatnot. I mean, that's just such an old, outmoded way. Everything's electronic now, and so if you want to reach tens of thousands of people very quickly, just put out an article. I mean, and you can see the stats. You guys can go, you Google my name, you'll see some of the articles I've written, and like places like Quora will actually track the number of reads on articles. So I get to see exactly how many people have read my article over whatever span of time. And I think that's the most effective way of reaching your audience and gaining also new readers that might find your material of value to them.
Yeah, as opposed to writing books. So, but I think I did. Yeah, I did actually. I posted a video that I did on swing trading a few months ago, I think. So I don't know. I'm gonna have to dig that up. Anyways, but we're gonna cover that sort of thing, and also the idea of swing trading and campaigning stocks, so that you're playing an overall trend, but you're in and out using various entry points and points of sale, shall we say, to guide yourself. So I'm going to go through this question. Is there a let me go through this. Blah, blah, blah. You write about the fact that you pyramid in your books and seem to imply that this was consistent with O'Neill's method. It was back then. So is there a modification on what is presented and how to make money in stocks, or does that remain a good guide for building a portfolio? I would say yes. As we just said, there is a lot of modification, at least the way we operate. And it's no longer a good guide for building a portfolio. It's a good guide for getting yourself really, really heavy into stocks just when everything breaks to the downside. So it seems much harder to pyramid in when you're dealing with a trendless market. Exactly. I'm dealing with portfolios ranging to 100K to 3 million. Would there be a significance if the range was 10 million to 50 million? I don't think so. Anyways, all right. Let's go through some more names on the on ye old list. Let's go to Facebook. Facebook is also another one of these situations like, hey, what happened to my weekly chart? It's here somewhere, isn't it? Here we go. Okay. It basically built a cup, and then it tried to break out, but there was a 1 week handle. So again, you have this premature situation where it hasn't had enough time to set up. So it backs down and runs into some selling. My thinking was, and Dr. K and I were talking about this last week, that some of the selling could have been an allocation trade. In other words, Facebook's a widely owned stock, and a lot of mutual funds and other institutional investors, and we know this from our experience advising institutional investors back when we worked at O'Neill, a lot of them can only hold like 2% position or 5% max position. So if a stock's rallying too much, it will become a bigger and bigger component, percentage component of their portfolio, so they'll have to cut some back. Now, while they're doing that, some other funds might be buying it and initiating positions or adding to smaller positions. So there will be a little bit of a, shifting of holdings here as the allocation trade, the selling takes place, and some mutual funds lighten up. And you're also fairly extended at this point. So the fact that the stock was able to hold the 10-day line on Tuesday with volume drying up, I thought was constructive. And so I'd actually been trying to scalp the stock short off the highs here, which I did, and I did it again, I think, last Friday. But it held up on Monday, and then on Tuesday it held the 10-day line with the volume drying up. So I actually went long stock, and I'm long it right now. I think it could go a fair bit higher, so we'll see. I think it's a slow trudger, but I think it'll do it, and it's a nice cornerstone of my current group of stocks that I own. Let's see. Glaukos just extended. Earnings coming up. It's supposedly on March 1st, according to what I'm looking at. And then we have JD.com, along with the rest of the Chinese stocks, has been acting well. So I've been reading that Walmart has been accumulating a position in the stock, which I gotta think is constructive for JD.com. Here's what it looks like on the weekly chart. So it's a little messy, but it's trying to come up the right side. But that's a pretty messy looking chart. So, but you notice how it has tightened up over the last 6 months or so relative to the rest of the pattern. So it's acting well. My preference though would be Momo, Weibo, or Baba, and maybe Nettie's as well, though that's an older name. But I like the three newer merchandise names. JD.com is relatively new, came public in May 2014, yeah. Anyways, and here's Momo right now. I think it's pulling back into towards the 10-day line. So I like it on the pullback in here. I'm actually waiting to buy it back, just hanging out. Mosaic, another commodity stock, and it's actually acting pretty well. I had a 5-day pocket here after gapping down, but notice how it breaks out and it fails. And this is a classic Louis pattern where you break down, you fall back into the base. So if you're buying things O'Neill style and you're buying the breakout, well, you're going to get kicked out pretty quickly, but it holds along the 20-day line. You get a little undercut here, and you may notice that the pullback held the 10-week line on the weekly chart, and so now it's pushing back to the upside. So you have to buy these on weakness, but that's a Louis, what I call Louis pattern, where you have a situation where, here's another one, the stock's acting really well, you know, like this here, and then it breaks down. And here, you know, like you're breaking out of a 3 weeks tight pattern here. It's wonderful. It's going through the 100 price level here. So it's a century mark buy. And then blam, they smash it on a big gap down on heavy volume. And then what happens? It stops. It retests the low on sort of a Wyckofian retest. You can see that here. So you retest the low here, and it holds up, closes near the peak of the range on lighter volume down here, and then it heads back to the upside. Now, I've tried hitting this. I think I hit it here on the short side, made $1 or something, and then I noticed it doesn't really want to go down, and tried shorting it again here, and it didn't really want to do anything, so I just backed away. And then you get this pocket pivot right here, which would have been day before yesterday or Wednesday, and now it's coming right back, and it's more than filled the gap. So this thing looks like it's just Louising right back up. So the L formation, you get an L. Let me see if I can make it look like an L. There's your L. You guys see that? I'll color it in. How's that? Kind of weak. And then the L formation here turns into a U, and that's a Louis pattern. See how creative we are? Anyways, if you got a better name for it, let me know. I'm open to any suggestions. Okay, let's see. But, you know, that's what these things do. So that's how this market operates, and it just throws you for a freaking loop, you know, constantly. Anyways. Let's see. What are we looking at now? Netflix. Well, you got squeaky tight. I was watching this like a hawk, if you recall from last week. I thought if it broke the 10-day line with some volume, I might, you know, fail. But it's held really tight. So you go long right there at the 10-day line on Monday, and it pops to the upside and looks like it wants to go higher to me. So, and then Netflix is interesting because it's just come out of a big base. And what's different, you know, we had a big Bible gap up here, and of course the stock comes right back into the 10-week line here. But what's different this time is that this one found resistance at the top of this range. Okay, this time we get a Bible gap up here, and it's actually breaking out of this range. So this may be more significant, and maybe there's better move for Netflix going forward. I do know that my kids don't they don't watch cable TV. They have their rooms set up as multimedia tasking centers using a flat screen TV that's connected to their various devices, and they use Roku and Netflix and Hulu and all this other garbage. And they seem to have better choices in terms of movies to watch. You know, cable TV is, what is that? Is that Bruce Springsteen song about 300 channels and nothing's on or something like that? That's what cable's become. So I think Netflix is the new standard, and it's just coming out of this big structure, so maybe it's got a shot. Quantenna, hanging tight. That looks pretty good. Earnings come out on the 13th, which is when? Monday? Is that right? So I don't know if I want to play earnings roulette here, but you know, maybe it pops out of here. It's acting pretty well. You got the volume dry up along the 20-day and the 50-day and the 10-day moving averages. Looks pretty good. Let's see, what else? Square gets support at the 50-day line, so that's where you got to buy it. You notice also, you guys see the undercut of this low in the pattern right here, and it coincides with the actual test and rebound off of the 50-day moving average, and it pops out. So that was an undercut and rally move right there. And if you're buying, once it gets above this low, which is 14.13, you could be buying it there and using the 10-week line or the 50-day line as your stop. They have earnings coming up, what, early March, and so far that looks pretty good. So I don't know if I'd play earnings roulette, though. I'm guessing, though, it's going to go higher after earnings. I don't know. We'll see. Am I going to hold a position? Probably not. There's a lot of other things working, and there are stocks that are working that have already come out with earnings, so I don't really need to mess around with something. Seagate is acting pretty well, but it's another situation where you have a wedging rally. So, but you know, who's going to buy it here? So, unless if you're going to buy it here, you'd use the 10-day line as a quick stop. Otherwise, you could get a yank back. I would just be laying back and wait to be opportunistic. So, you know, people have this tendency to see something going up and they have to get on it. Somehow it's like a moth. It's the moth syndrome. You know, the light of upside is beckoning them to come and buy a stock just because it's up. And in this market, you have to be opportunistic and wait for your pullbacks. Be patient. You'll get your shot if there's something you like, and it may be a little higher, but at least it'll be in a lower risk position, and that's what I would do. AYA has better growth than Twilio. So what? It's a cheap little stock. You know, it's a piece of garbage. And Twilio is not trading on earnings, it's trading on sales. They actually had a nice top line performance on sales, so their bottom line wasn't so hot, and it's a $31 stock. I don't, you know, and trying to make a comparison between stocks and say, oh, well, their earnings are up 20% and Twilio's earnings are up, you know, 5%. That's really not going to tell you anything, and this is a very, very sloppy chart. 98,000 shares it trades a day. That's kind of junky. I wouldn't be messing with it. So I wouldn't go for that sort of simplistic comparison. You know, I think Walmart has better earnings growth than Twilio, if that's what you're looking at only. But and even Tesla. But situations are dynamic. Look at Tesla, just keeps going. That's a viable gap up, isn't it? It's kind of extended, or is it an exhaustion gap? I don't know. But you can see the bottom fishing pocket pivots here around the 50-day line and then around the 200-day line. And those work. See, now by the time we're getting right up near the old highs, earnings coming out on the 22nd, I believe, of February, so we'll see what happens. But that, you know, this is a stock just chops back and forth. There's no real trend. You get a nice price move on the moves off the lows, and then they tend to peter out, and we'll see what happens. I got to think, though, this thing is getting close to a point where it needs to base. We're up 92 points on the Dow right now. We're at 20,264. Have you guys noticed that everybody's talking about how low the VIX is? That we're now 85 days in a row, or I think it's probably 87 or 88 now, days in a row without a 1% correction. But what does that tell you? Absolutely nothing, actually. And also, people are pointing to investors' intelligence, which is showing a huge amount of individual investor bullishness, which, you know, I guess is the end of the world. But I wouldn't really pay too much attention to those things unless you are seeing stocks breaking down. So it all boils down to what the stocks are doing. Hey, Dr. K, in 1999, when we had that big rush at the end of the year, wasn't the VIX like ridiculously low? Because I remember people talking about, oh my God, look how low the VIX is. And we just kept going higher.
This is the thing with using statistics. That'll get you into trouble every time. The markets change, as we all know, and you do have extreme conditions which occur more often than we think. So right now, people are using the VIX as a reason to short the market or say that the market's not going to go up much more. It needs to correct all of those things. The VIX volatility model is aware of that. It doesn't use any of that, which is how it's able to stay the course more or less. I'd remind everyone that if you look at 2006, the last time we actually had a truly open window in the markets that were unfettered and unmanipulated was the last half. Well, it started in, I think, August of 2006. And you'll see that the VIX went to nearly all-time lows. And I remember back then people were trying to use the VIX as a reason to go short the market. And that, over a period of about 3 months, that was the time that I played pocket pivots and ran my account up about 115%. Because, like I said, the window was wide open. It reminded me of the 90s, or even the 80s and the 90s, where you had a lot of open windows back then. So using statistics will get you in trouble, but using stock performance, price volume action on stocks, will keep you roughly on track, or a hell of a lot better on track than any of these other nonsensical statistical studies. And of course, you know, I'm a statistician and all of this, but I keep statistics in context of the bigger picture. And most of the time, you really cannot use statistics to guide your trading, especially in these years since 2009, since QE is pretty much obliterated. Any statistics that did work or did have the odds in its favor, like for instance the day before earnings, if you look at the price volume action of a stock, that was an indication that 8 or 9 times out of 10 you'd be on the right side and the stock would gap higher. But past after 2009, well, it was Regulation FD that I think crippled that. So, and I think when was Regulation FD anyway? Wasn't that around that time?
Sometime
2008,
around, yeah, they put it in sometime around then. So, but I remember also they're saying that the Dow or the market hasn't had a 1% correction for 80-something days now, and the last time that happened was 2006, and of course the market continued higher throughout 2006, and I think it finally did correct. You can see on the VIX we got something going here.
Well, what I want 2006 is when that window closed, it was very clear that it had closed. So I think I ran my account up something like 130, you know, at the peak, 130 something. But then after I'd closed out all my profits, and I was doing a bit of swing trading on some of these, but some of the better ones I was able to hold over a period of weeks, which, you know, in some cases went up well over 50%. But when the window shut, it was pretty close. It was pretty obvious, so that my account standing over that range of time finished up 115%, and it was a very clean market, like the markets we saw in the 80s and 90s. I don't know if we're going to get back to those clean markets again. It is good that, well, the QE here has backed off to zero, but unfortunately the QE out of the Bank of Japan and the European Central Bank is still quite measurable and pronounced. And of course there's bleed over from that. Not just bleed over, there's a direct flow from that QE right into the U.S. market. So markets are still being manipulated by this QE phenomenon until the ECB and the BOJ really start to rein in their QE programs. And I know there's indication that they are on the way there. The trend, let's just say, is favorable toward less QE in the future rather than more QE. So, you know, that bodes well for less market manipulation, which implies potentially cleaner markets and therefore potentially cleaner price volume action in stocks.
Okay, let's see. We get another question from this person, Matthew. All right, you get. I guess we'll answer these questions, and that's all you get on the day, Matt. Sorry. I think he's gotten his money's worth. But anyways, I've gotten the message that you are putting stops in much earlier in a sideways market and that you're taking profits earlier at 10 to 25% rather than holding out hopes for a long-term trend. I'm having trouble reconciling this with trend following plan where profits are taken based on what the stock is actually doing rather than an arbitrary profit target. Well, I don't have an arbitrary profit target. I look at areas of potential overhead resistance. I mean, if you're paying attention to this webinar and trying to maybe learn something instead of fixating on questions where I'm showing you the answers as I'm going through stuff, I show an example of X, okay? I buy it here. You have the pocket pivot. It holds tight at the 10-day line. Buy it here. It runs up to the top of the range. Well, chances are that's going to be a short-term point of overhead supply. So I'll sell into that right there at 38, okay? And then I'll wait and see if it pulls in and builds a little handle or goes sideways and then look for a point to come back in. And I'm able to use the moving averages, either the 10-day or the 20-day line here, or the lows, or even this low here at 31.33 if I wanted to, although I probably wouldn't because it's too deep. Probably the 10-day line. I use that as my stop. I'm not using 6, 7, 8%. As far as I'm concerned, that stuff is for morons. But people like things put into a nice little package. You know, they want everything canned for them so that it's easily, you know, they put it in the can opener and open it up and pour it into a saucepan and they can cook it and eat it, and it's very simple, you know. But no, trading isn't like that. Trading is like cooking an 11-course gourmet meal, okay? So if you think you're going to rely entirely on recipes, it's a little more involved in that. And I think that a lot of what IBD and you know, how to make money in stocks does is oversimplify things, and a lot of people get burned. using the system because they don't understand that they have to be able to think for themselves rather than just relying on some statistical rules or some other BS. You know, it's just, and I've just seen people get chopped up and they can't really understand anything unless it's put into a 1 + 1 = 2 sort of format. So, you know, I think it really boils down to recognizing and accepting the fact that you can figure out the market on your own. You don't need somebody to tell you what to do. You don't need some stupid rules. If you pay attention to what the market's doing, you will develop a feel for the market, and then you can derive some procedures and ways of operating based on what you're seeing happen in the market itself in real time. So, you know, my adjustment has been to sell into sharp upside moves, and then when something starts to base, like let's say if you bought the Bible gap up on X here, a very reasonable way to handle this right away would be to use the 10-day line as your selling guide. Once it breaks down through the 10-day line, well, now we're going to start basing. So that would be a point where you could back away and then let it go sideways and start to come back in the base, and that's what I would do. So I would sell into that, then come back into the base. And I'm always trying to use the tightest stop that I can based on the nearest level of support. So like I'm talking about with Momo just a little while ago. I'm not going to chase that move, but I'm going to look to enter on pullbacks in the trend, and there is a trend here off the lows. And you can see this is a Y copy and retest. And here's how you use a little bit of common sense and also comparing weekly and daily charts. Here we come into the 200-day moving average and you bounce off of it. Then you come back in and you retest it. Notice how the volume on the retest just at the end of December is much lighter. So that's a white coffee and retest, as I call it. And the stock comes out, it posts a bottom fishing pocket pivot at the 10-day line. So I put those two things together, I'm in the stock there. And I actually did buy this thing like under 19, believe it or not. And then it ran up, I sold into that, and I've been working this thing the whole way. But every time it runs up like this, you can get a sense that it's running out of gas because there's some overhead from the left side of the pattern. Sell into it and it comes back in. It's a much more active approach, and it's not always perfect, but I have a group of stocks that I'm working this way, and I'll move around between them all as I'm campaigning them. And how do I know it's not overtrading? Well, to me, overtrading is if you're trading a lot and losing money, okay? And overtrading and making 40% plus a year average for the past 4 years that I've been using these methods tells me I'm trading probably just right. If I could cut my trading down a little bit and figure out areas where I could, or stocks where I could have sat, and there's some way to figure out that I could have done that, then I'll modify my methods a little bit on that basis. So I hope that helps. But that's, you got to use some judgment and also watch and see what is the market doing. I think people who keep buying breakouts and getting hit on the head you're idiots. The market's giving you feedback and telling you what's working and what's not working. And until that changes, I'm going to keep operating the way I've been operating for the last 4 years since I decided to focus on running my own money and not trying to run other people's money, which is a disaster. Anyways, last question for you, Matt. Go ahead, Dr.
Mention the recipe formula worked a lot better in easier environments like the 90s. You could use CanSlim, and you could be a retailer and do pretty well with it. But the markets have been far more challenging since 2009 with the QE phenomenon and the manipulations going on. And so you have to stay in tune and stay in sync with changing environments. And then as people can see through our archived reports that go back to 2010 as far as the website's concerned, they can see how our strategies have morphed and changed over time. And right now, and actually the last few years, the best way to go has been to take profits when you have them, but in context with the stock's chart. That means if you're sitting on an NVIDIA, it never really did anything too wrong. It never got ahead of itself in 2016 for a lot of that run, so you could still sit in the position. If you go back to when we were putting it on when it was trading in the 30s, there was no reason to sell it, but there's a number of stocks that are not as high quality, and they might have their big 2 or 3 day blow-offs where they're up 10% or more, and in context with the chart pattern, it's clearly a time to take some profits at least. So you got to morph with the markets essentially, and of course buying on weakness. That's not my trading style in the 90s, but I've obviously adjusted myself so that I can reduce my risk considerably by buying some of these what we call the voodoo setups, where it gets real quiet and tight in the price volume for a number of days. And that usually, and also if it's right near support, you know your exit point. So I can initiate a trade with, say, a 2% downside risk. You could have done it on a number of these names. Baba's extremely clean. I think your risk on that would have been about 1%. But your upside on these is at least 3x your downside. That's kind of a rough rule in terms of risk management. Get into a trade where if your risk is say 3%, then you better be looking at a 9% or better profit. And if you keep doing that, you can lose twice for actually you can lose 3 times for every 1 time you gain, and you'd still break even. And odds are that you're going to do better than that because obviously, as we do, the stocks that we put out there are leading stocks or leading stocks in their sectors. So again, we want to put the odds in our favor as much as possible. So I guess this is all addressed to the individual who's been asking a lot of questions, and go through our FAQs, read our books, and you'll really advance your knowledge considerably.
Yeah. Last question. Martin Armstrong is suggesting we're in for a strong trend through 2020 or so. Who cares? Why do I care? I wouldn't pay attention to that. That doesn't tell you anything. Maybe we are, maybe we aren't. We were in a strong trend from World War II to the year 2000, but that doesn't mean you can't have a nice correction in between. So that kind of stuff is meaningless, and I wouldn't even pay attention to it. And I think that sort of thing, people pay attention to what this person or that person says. Like Harry Dent says the market's going to go to 21,000, and then we're going to have a huge 70% correction in the next 3 to 5 years. Oh, well, that's helpful. Just watch what the stocks are doing. Use your brain. You have one. I bet you didn't know that. But everybody has one, and it's a lot more powerful than you give it credit for. So, have a little belief that you can actually figure things out if you get a sense of what it is you're looking for. And I think a lot of that comes with experience. So, I think a lot of people become too dependent. The whole guru thing, I think, is BS. There are no gurus. Dr. K and I are not gurus. We can't tell you, give you some magical rules that are going to work. We're always adjusting, making mistakes. And I like to say I'm wrong twice for every time I'm right, and I can still make a ton of money. And that's okay. And you got to let yourself be wrong, too. Anyway, so you want to know what kind of confirmation do we need to see before we begin modifying our approach for a trending market? I don't really know. Nobody's going to ring a bell. What you'll notice is stocks will be trending better. But maybe we're starting that now. I don't know. But, a simple way, if you want to give things more room, just go and read about the 7-week rule, which people could have used on NVIDIA and actually would have worked pretty well as long as you want to give it some room. If you look at the pattern, it's not so clear along the way. You can see a few dropouts, but for the most part, I see a lot of nice, like you buy the viable gap up, it runs up, it starts to slow down. You can see the volume starting to peter out on the way up, and so you could take a profit, and then you get a shakeout here. It's an undercut and rally move. It turns, you could buy back, it goes back up. You get pocket pivots along the 10-day. So there are a lot of points where you could be selling, taking profits, and then looking to come back in. That's how I'll handle a trend. So I don't really have to adjust or have somebody ring a bell for me telling me that, oh, you're now in a cleanly trending market. If that happens, I'll observe it happening. But in the meantime, I can exploit trends pretty well using my methods currently, and that's what they're designed to do. It's not just like, oh, take a 20% profit and then go away. No, you look and see where's the stock trading, and I just explained like on X where I have taken a profit on a trade recently, and go from there. So, anyways, let's see. Somebody's saying nice rip CTRL. Well, it's a Bible gap up, so I don't really get the point here. Okay, your swing trading video was from July of last year. You have a link to it in your last report. Okay. PPV yesterday worked. What's PPV? On CT? Yeah, it was. So why didn't you tell us about it yesterday, JT? Jeez. 57 channels and nothing on. Thank you, Wilfred, for clearing me up on that. Pink Floyd, 13 channels of Schmidt on the TV to choose from. That's how it used to be. How much distance is desirable for a UNR pattern from the current low to the last low? No, there's no desirable distance. What is desirable is the turn back up to the prior low. So, you know, come on, Scotty. You know I don't operate on that sort of anal retentive level, but what is so bad, dangerous about wedging in general? Well, the idea is that as the stock is moving higher and volume is declining, you're seeing a buying interest diminishing, or a buying starting to dry up. So that makes it susceptible to a pullback. I have noticed, though, in this market that a lot of times that just fakes you out. So it's, you know, it's sort of a not as reliable as it used to be. A lot of those old O'Neill rules don't work anymore because you're not in a secular bull market. You know, maybe we're going to start one. I actually have a lot of hope for what Trump might get done. And I think I like the fact from a contrarian basis that a lot of people are just like ramming the guy and reaming the guy, and he's not doing this right, he's not doing that, but he's actually getting a lot done. I noticed the other day I saw on TV, he was on TV with a bunch of people in his office, and he has huge stacks of paperwork on his desk. Now, for 8 freaking years, I saw hundreds of times Obama sitting at his desk. Not once did I see anything more than a single sheet of paper that he was signing, you know, in his sort of gratifying, smug sort of way. And so I don't even think that guy works. He's mostly interested in smoking, drinking, and playing golf and basketball. Anyways, can you please define open window? Oh, it's a window that's open? I don't know. Who said, did you go and use that term, Dr. King?
Yeah,
Open window is when, you know, an open window is when you have a buy setup. There's an open window to go long. You're using open window, I think, in too broad of a sense, though. Or at least people are trying to interpret it as something specific when it's just a very broad thing, and mostly best determined in hindsight, don't you think?
You know, here's the thing with open windows, and it's just a term. I think we've used it in our books. All it means is when you've got a confluence of high-quality names that are all firing buy signals. We haven't really had that since 2006, late 2006. That was the last time. Prior to 2006, you had 2003 where that happened, and then prior to that, you had the 1990s all the way up into, you know, March of 2000. Of course, there were major pullbacks, major market corrections, but when the green light was on in the markets in the 1990s, the window was open. You had more than just a trickle of names. That's all open window means. So we haven't had an open window in more than 10 years. I was starting to see a little bit of evidence post-elections, and it was really actually this year that a number of interesting names started to hit my alerts, and they were all buyable. And that was the first time that's happened in a long time. So I thought, well, if this keeps going, then the window is really going to be wide open, but it didn't get there. So the window still hasn't really been, you know, it's really a wide open phenomenon of, you know, a confluence of great stocks doing the right thing. That's all it means. So, you know, are we going to get back to that level? Who knows? Maybe. I mean, if enough of Trump's policies can take hold, you know, maybe we'll get a like a post-Reagan situation when his tax policies took hold. That was the beginning of the new bull market, which began in, I think that was 1983. No, that was 1982.
Right.
And yeah, that's the whole 80s tone of big open windows that happened quite frequently in the 80s.
All right, let's get back to some stocks. I think we're wasting too much time on this baloney. Vive, I think, is acting pretty well, but they came out with earnings, I think, in the first week of March. But you can see, here's an undercut and rally move. You can see it undercuts this low at 42 and turns back to the upside. You get a pocket pivot, which doesn't clear the 50-day line, but it clears the 10-day and the 20-day. So for me, that's good enough. I don't need, in these bottom fishing pocket pivots, I don't need to see the stock above the 50-day moving average. And it's just setting up, though, is what it looks like to me. So we also have this Zion Bank is just going sideways. But, you know, I would, if I was going to play financials, play some real financials. That's what I think. Goldman Sachs had a pocket pivot last Friday. That looks like it wants to go higher. JP Morgan also had a pocket pivot last Friday. It's just tracking sideways. But I think these are probably going to get more juice. Schwab we were looking at last week, that was a short, and it's back at the 50-day. I wonder if it's still a short, but it's not really able to get above the 50-day moving average. So anyways, someone's asking about Qualcomm. Well, that's a piece of garbage. I'm not going to buy it down here. You could try it if you had some sort of basis for doing the trade here, maybe an undercut of the intraday low on this gap down day, which is 53.77. So you could try this using either the 10-day line or this 53.77 low here as your undercut point in the pattern as it turns back to the upside. So you could try that. And I don't know, maybe I wouldn't be surprised if this thing came all the way back to the 200-day line in classic, well, it's not really a Louis pattern, but in just ugly duckling fashion. So INFY, we're cruising along pretty well here. We're up 92. I don't really see anything here. It's coming back up above. That's not a pocket pivot at the 50-day line, but I don't know. There's ways to trade this if you wanted to on the undercut and rally attempt, but I think it's a little bit gone from there. Let's see. Somebody says, regarding your over trading comment, what's the average profit percentage for each Momo trade? I don't know. I don't really calculate it. All I know is I sell it and buy it and sell it and buy it after I get some nice moves. So if you want to go through, you can calculate it here. So bought at 18.38 and sold up here at around 21 and change, and then bought back at the 50-day line, and then sold up here at like 23 and change, and then bought back here, and then sold up here. So, or maybe I think I bought it back here. So I don't know. I'm getting a good buy. Well, I'm going to say 10. This is 10, 15%, but I'm only taking like 20, 25% positions. So unfortunately, I'm not plunging the way I used to back in the good old days. Although right now I'm running pretty big positions in Netflix and also Facebook. So somebody says, so do the seminar on Thursdays. Do this, okay. You know, yeah, I think maybe we should. Anyways, we'll talk about that. But that's a timing issue, I guess. But this week, Arcade's been kind of busy. He's moving and stuff. So Skyworks Solutions looks like a nice flag. Buy it.
I've had people tell me that they want to have it on a specific day, and we can't, cater to everybody's needs. I know some people want it on Friday, some people want it on Thursday, some people want it on earlier in the week. And I think we just when we do I base, when we plan our schedule, we usually talk about it that day or the day before, and because our schedules shift, and so we're trying to find the best time that we can both accommodate.
Right.
But we want to keep it in the morning because that seems to people seem to prefer it in the morning. We talked about going Monday or Tuesday. That could be okay. But yeah, I get the sense that the way we've been doing it, we haven't really had any issues in terms of the timing.
I guess we do them when we do them. Anyways, SWKS, I mean, that looks like a flag. It wants to go higher. I was looking also, I own a little bit of these two, RCL and CCL. I did pretty well shorting these last year, and now they've seemed to have turned around and moved higher after earnings, and this one had a pocket pivot holding tight. They look interesting. Might be good for a trade up to the highs. That's what I'm hoping for. Let's see. Ambarella, I think, is an interesting one because there's a lot of talk about the drones and all, but I think they come out with earnings fairly soon. I want to see what happens after that. But the cybersecurity names, we like the Fortinet and the CUDA, Barracuda. And Palo Alto Networks has been trucking higher. You can see we've had, and I talked about this over the last 3 weeks, as you've had these pocket pivots coming above the 200-day here, a bottom fisher down here, 200-day here, 10-day here, and it's just cruising higher back up to the highs. Now this is what the base looks like, so that looks like garbage, but they come out with earnings, I think, in the next 3 weeks, I don't know. But I would be watching that. In the meantime, I kind of like the CUDA, which is acting pretty well here. I also like Now. ServiceNow is another name. This is a viable gap up and got tight. You see how this is another one that hangs tight along the 10-day line. So you see that in SWKS. You see that in RCL. You saw that in Netflix. And then they go higher, but they take longer than usual, so they don't just blast out of here. Now, I wanted to cover these real quick because these are stocks that we said to watch after earnings to see if they morph into shorts or see what happens. And looks like Activision came out of this pattern, and you see how this looks like a head and shoulders, and maybe you're forming the right shoulder, but after earnings the thing gaps up, and maybe it's a viable gap up, but it's trading mid-range. I'd watch and see what happens. Now notice EA in response to the news That was a good scalp on the short side, but it comes down into the base here and finds support, if you're watching this, at the 10-week line. So if I was shorting this, I'm covering this coming down, and once I see it hit the 10-week line, I'd be covering and then wait to see how it reacts to ATVI's earnings. Of course, you get a viable gap up, and I think, well, maybe it's not enough of a gap, but to me that looks like it wants to go higher. And my 15-year-old son tells me I'm an idiot for thinking that any of these video game stocks are shorts. Okay, so and he's been right on these for the last several years, I think, and I haven't. So I'm going to go with that. He's probably right. Anyways, so those are out the window, and those didn't really work. But there's also feedback that is gained from that. If you pick on a couple of shorts and they don't really produce big gains, or they don't break down, or they do say something like this, and you could see this one coming, because when CAP failed here, I shorted it, and you get a scalp to the downside, a couple $3, and it undercuts the lows in here, okay, and then it turns right back to the upside. Now, here we go, and that would be a Louis sort of formation. And that was one that, Schwab is another one I like to campaign, or I've been campaigning on the short side, but it's not really breaking down, and for all you know, it'll come back above. Look at like Finisar looked like a short for a while. Now it turned around. You had a bottom fishing pocket pivot here 4 days ago, and it's cruising higher, along with Lumentum, which is looking like garbage, and now it's broken out. This is a crazy stock, difficult to deal with. But I also noticed Fabrinet is coming back, and Juniper. Here's this one's probably higher. Yep. Here's a little bit of a, not really a Louis, but a big shakeout, and it looks shortable up at the 20-day line. I tried shorting it up there, but you could feel it just doesn't want to give way, and so it turns back above the 20-day and probably going to go back up towards the high. Sienna, you have to buy this thing at the lows of the base, and that's another one in the group. Acacia is a piece of garbage, just doesn't want to get going. Let's see. But I think there are enough actionable ideas here in this market that anybody's paying attention can snag something. So I like this SWKS right here, though. Avaga's been doing pretty well, Broadcom rather, and it's up there. I don't think they've come out with earnings yet, have they, Dr. K? Did they?
Not yet.
Okay. Keep an eye on Mobileye. They came out, I believe, the week after next, and they're kind of tracking tight sideways. There's talk about companies are going to, they were testing, I guess, a couple of driverless trucks for shipping goods or something, and that may come into play. So I got to think Mobileye is a player in that. I like the way the stock is holding tight along the 20-day line here. Volume is drying up, so that looks pretty interesting to me. Anybody who's a fan of Airgain, I think they come out with earnings. This one might be setting up to get out of here, maybe after earnings, but I keep an eye on that one as well. Anyways, let's look at Allegheny. Here's another one. A Bible gap up goes tight sideways, but then breaks down to the 20-day line, and it's holding. I don't know. I think I like X better, but I noticed some of these Steel Dynamics is on the comeback trail. So you can see it had a pocket pivot, I believe, yesterday at the 50-day line. So you'd buy it here using the 50-day line as your selling guide. And this was one that we had on the list. We took it off when it violated the 50-day moving average. But notice how it undercut these two lows here, and we're back in business. Just like that. And that's how this market rolls. So you've really got to be looking at different entry points and taking advantage of things on an opportunistic basis in this market. That's really the best way to operate. Buying into strength, I think, is just become an outmoded dinosaur-like method. So anyways, we've run over by 10 minutes, but whatever. Anyways, you guys, hopefully it was helpful, and you get an idea of what's looking good, at least right here, right now. And we'll have a great weekend. We'll catch you next week.
So long, everyone.